Hello, this is Maddie Heckman with Markets Group, and I'm joined today by Bob Fontana, who is the Chief Investment Officer at Investors Trust Company. Bob, thanks so much for joining us.
Absolutely. Thank you.
So, Bob, let's start with you giving a little bit of background and a quick intro on yourself.
Sure. Well, as you said, I'm Bob Fontana. I have been the Chief Investment Officer at Investors Trust for going on 11 years now. Investors Trust is a wealth management firm. We also have trust capabilities, obviously, as our name implies. We have been in business for 20 years. We are actually owned by Investors Title Insurance Company, which is publicly traded. We have about $1 billion, give or take, under management, and we primarily serve high net worth individuals, foundations, endowments, 401ks. We do have some corporate assets in there as well. We're a little bit different, I guess, from a typical money management firm, just in that we run our own SMA strategy, separately managed account equity strategies with individual securities in them, and we buy individual bonds as well. And then we complement that with exposure to other asset classes via funds and ETFs. So that's what we do.
Okay, great. So, Bob, what is your outlook for the 2024 markets?
Well, as we sit today, the equity markets at least, have done very well so far. I mean, we're up over 6% year to date. The markets have basically gone straight up since their lows in October. So I guess on a short-term basis, we're probably due, if not overdue, for a little pullback in the equity markets. But on a longer-term basis, I would characterize us as hopeful, but cautious or nervous on the equity markets. Hopeful in the sense that the economy has been much stronger than we in the street expected, and that the U.S. consumer, frankly, has been stronger than we expected. And with a backdrop that unemployment's low, 3.7%, wage growth is over 4%, that lends to a pretty healthy consumer that's clearly indicated a willingness to spend. So we're hopeful in that regard. We're nervous in the sense that earnings expectations are pretty high for this year. The street consensus right now is calling for about 11% earnings growth. That's down from 12% a few weeks ago, but that's probably it's roughly twice the historical norm. And so if we have an economy that is still growing, but less so, that could be a tough bogey to hit. We're certainly worried about inflation. That has been stubborn. We do think interest rates are probably going to be higher for longer than folks expect. And of course, it's a presidential election year, which I don't think the market has really started to focus on that right now. So we're hopeful that the economy can stay healthy, but nervous given things I said.
Yeah. Okay. So how have you changed your allocations for the year ahead, given some of those maybe macroeconomic factors playing into your strategy?
Yeah, well, as we sit today, we've recently gone to slightly underweight equities. Again, given the nice run we have had, we do like fixed income. We're overweight fixed income in large part just because for such an extended period of time, you couldn't get any yield to maturity. Now you can at least get some decent yield to maturity. We like that. With that said, though, we are keeping our bond portfolio short because we are concerned about upward pressure on rates, not just for inflation purposes. And again, we're having this healthy economy, but what's not being talked about all that much is the amount of debt the U.S. Treasury is going to have to issue, not just to support our normal spending, which our politicians are very good at doing, but just the interest costs on our debt now is much higher given higher rates. And so all that could put upward pressure on rates. So we like fixed income, but we are keeping durations fairly short. And we're also overweight alternatives as well, which alternatives I know is it means different things to different people. For us, alternatives are master limited partnerships. Those have been great and generate a nice income. We've recently added exposure to some commodities. We're out of commodities most of last year, but we've recently added exposure again with the economy being better and inflation perhaps a little more persistent and stubborn. So we've recently added some exposure there, but we are overweight alternatives as well.
Okay. Bob, what is your take on a potential tech boom looming? And if that were the case, how would that impact your portfolio?
Yeah, you could almost make the case that the tech boom is already here, I guess, right? Certainly some of the stocks in the market would suggest that. I know artificial intelligence is all the rage right now and whatnot. And as we look at that, the demand for let's call it AI infrastructure has really come from a narrow area. It's come from data centers, it's come from hyperscalers, it's come from cloud service providers and whatnot. We're just starting to see demand for AI related stuff for enterprises, for companies, that are embarking on their own AI projects. And so I think the question is really just how sustainable, are some of these things going to be? With more AI comes greater need for security, right? And so it's not that cybersecurity wasn't important beforehand, but it's gotten that much more important, or will get that much more important. And so really, I think we could make the case that we're already here. In terms of impacting our strategies, I would say certainly we just have to make sure we have exposure to those areas. But I think it's always important to remember your risk management disciplines, because I think it's easy to get complacent and that, hey, it's artificial intelligence and that's just going to be great, right? So I do think it's important to, hey, if you've got big gains or too much exposure, go ahead and trim that exposure. All these stocks that have been up big the last, year to 15 months, well, they got killed in 2022. So we're quick to forget that, right? And so, so I would say just make sure you don't forget your risk management disciplines along the way.
Okay. In a previous conversation, you and I had spoke about disruptive healthcare. I would love to dive into that a bit. So how are you leveraging disruptive healthcare to balance your portfolio?
Well, with our conversation, we really like, you call it disruptive, you can call it emerging healthcare, where it is. We like it for a host of different reasons. One is the growth profile is different from technology. And so there's long-term growth potential with it. And it tends to be slower, steadier kind of growth, as opposed to, everybody gets all excited about being in the hot tech stock. It tends to be less that. So we think that helps balance out the growth profile of portfolio. So we do like that. With that said, how we've chosen to play it, I canvassed the landscape of funds. I wanted to play it with a fund of some kind and whatnot, but the stuff that's out there that calls themselves, whether it's emerging healthcare, disruptive healthcare, you lift up the hood on what they actually own, and it's Eli Lilly, it's which, they've got a weight loss, a GLP-1 drug and whatnot, but we can own that in our individual SMA strategies. It's got intuitive surgery. It's got stuff that we could already own.
Okay.
So in that sense, I was disappointed. So we just built our own emerging healthcare portfolio that we're actually in the process of putting into client accounts where it's appropriate to do so. One thing that's nice, I think the timing is nice now, because unless you were Eli Lilly, basically last year, if you were healthcare last year, your performance stunk. Healthcare stocks really had poor 2023s. And so unlike tech that had really good runs last year, healthcare didn't. And so it's so far, knock on wood, so far healthcare's doing okay this year, but I think it's just better entry points for that area. Okay.
So, Bob, there's a great deal of movement, as we've discussed, around private credit right now. A lot of interest there. Why are you steering clear of that industry segment?
Well, I guess it's, I know we had that conversation. I guess it's less an indictment about private credit itself. I mean, look, I guess private credit right now, you can get low double-digit returns in, and that's certainly attractive. There's transparency issues. Yes, there's lockup issues and things like that. Those are concerns. But really, it's more about the fact that everybody and their brother now has a private credit offering. And so our experience has very much been when everybody and their brother is pushing something, the returns are below expectations, if not outright bad. And in the case of private credit, maybe it's even more concerning, because A lot of people pushing private credit right now maybe don't have, they may have credit experience, but not private credit experience. And so, so what happens in a downturn where there will be a downdraft, right? Private credit, what's going to happen there? Do they have workout situations and whatnot? And then frankly, they can sometimes, the less seasoned can screw up pricing that the more seasoned players would typically get. Maybe a seasoned fund would get outbid, for example, by somebody who is less experienced, and therefore the returns won't be as good and whatnot. So for us, look, we can get high single-digit returns in transparent, public, fixed income. So yeah, we're sacrificing a little bit with the low double-digit returns of private credit by not participating in it. But I don't know if when all is said and done, we'll actually sacrifice that. We might, but I don't know. So for us, we're just like, we'll let everybody else, I guess, play in that space, I think. So again, less about private credit itself and more about, the actual managers and the dynamics or the structure, if you will, of the market itself right now.
Okay, brilliant. Well, Bob, thank you so much for taking the time to chat with us today. Thank you for lending your expertise to our listeners.
All righty. Happy to do so. Thanks so much, Maddie.